Welcome back everybody, your typical bull here, and today we're going to talk about the stochastic and the slow stochastic indicators. But before we get into it, please remember to like, subscribe, and comment. Your support really helps the channel to grow, and if this channel has helped you to become a better trader, consider subbing through the YouTube membership program. Costs $4.99 a month, or joining the Patreon page. You'll find links to that below. So the stochastic is a very common oscillator, and it's also going to follow momentum like the RSI and the MACD. It compares the closing price of a security. It is used to determine overbought and oversold trading signals, and it has readings from 0 to 100, with readings of 80 being considered overbought and 20 are oversold. It can be adjusted to different time frames. My favorites are 5-3-3 for the standard stochastic and 9-3 or 14-3 for the slow stochastic. Standard stochastic and the slow stochastic are very similar. However, the slow version will be a smoother line and generate less signals. I personally prefer the slow stochastic to the fast stochastic because you get less false signals. So the standard and slow stochastic, you can see in my little picture here, are pretty much almost identical, the 9-3 to the 5-3, but there is much smoother lines here for the slow version. It's generally more useful in a trading range than the RSI indicator due to the formulas used to construct them. It measures the speed of price movements, and this is better suited to trending markets, whereas the stochastic functions better in a choppy or a range-bound market. However, you can use the stochastic in a trending market. You just need to be aware that you're going to get different kinds of signals in a trending market than you would a sideways range-bound market. So the stochastic does produce false signals just like any indicator, so it's important to use it with confluence with price and other indicators. It's definitely not magic. So it can be used as an overbought or oversold signal. You see here stochastic is below 20, and then it comes back up above that 20 line and price follows, and then here you can see it's above 80 and it does come down below 80, and that's used as a sell signal here. Divergences, same thing with the RSI. Price is making lower lows, stochastic's making higher highs, price soon follows higher. And as a trend following tool, there's trends in both stochastics. You can see price is also following that same trend. And we're going to look at some actual charts here. I'm looking at Bank of America. So as you can see, definitely tell a difference here in the 5-3-3 stochastic to the 14-3 slow stochastic. And I have some other drawings on this chart as well. I'm actually going to delete them to make this a little bit easier for us to get through. So let's just scroll back here. You can see that we do have some overbought signals here above 80, and both of these are very, very similar to one another, but this slow stochastic does give less signals, but I think the signals for the slow stochastic are more accurate, especially for a longer term trade. See, the slow stochastic, I'm sure we'll run into some, you'll get some false signals. I'm sorry, the fast stochastic will give you false signals on a longer term basis, but it's generally pretty consistent on a shorter term basis, and we'll run into some of that. This is a signal you get on both charts, but let's see if we can find where one gives a signal and the other does not. But as always, it is super important to remember that you need to use this in confluence with other indicators, right? So here it's a pretty clear double bottom. If you were going to play this long, the 14-day stochastic gives you a perfect signal that you can use in confluence with this double bottom here. And then of course, if you're using the fast stochastic version of this, you can see there is sort of a price divergence here as well. this is starting to trend up while price is still remaining flat. And still trying to, I saw one earlier. I'm looking for a area where one gives a signal and the other does not. Here's an example of a trend in the stochastic. You're making higher lows here. Price is steadily moving higher in this trend. And of course, you will get false signals. And that's something that we could talk about right now while we're sitting here. So generally, if you are using the stochastic in a trending market, like here, we're obviously trending, you definitely want to be trading in the direction of the trend. So all of these overbought signals, you would want to be ignoring those when you are in a very strong trending market, because as you can see, this is giving a lot of overbought signals that aren't really causing price to fall. And the stochastic does remain in this overbought territory for quite a while here. Here's one of those range-bound trending markets that the stochastic will function quite well in. As you can see, most of the time you do get good signals here from both stochastics and these sideways markets. And it is important to understand that just because it's at 80 or above doesn't mean it can't go higher than that, right? So you want to wait for these confirmations and keep in confluence with your price action, right? So if this just don't go short as soon as stochastic starts giving you that signal, you want to wait until price confirms it and the indicator confirms it, right? So you see this is starting to come down, and then it comes down below 80 right here. So, and then you have this little price, flat price zone here as well. Once that, you could get in a little early here, so you've made a double top here. There's the double top, and your stochastic is also moving down as well. That would be your confirmation. So if you had waited just for this price break, you wouldn't catch that until here. And of course, stochastic is giving a buy signal here. It's almost to the oversold level. And then, of course, on the other end of that, it starts hooking back up again, and you don't get that confirmation until around in here. It's this previous support level. It looks like it's bouncing from that previous support level. Stochastic is hooking up, so that's a good way to use this in confluence with price with support levels to keep it very simple. Same thing with all of this. Previous support level. Stochastic is below, and then it's moving back up above that 20 level. And then, of course, you can target these previous levels here, or just get out as soon as stochastic hits the 80 mark. It's a fairly simple indicator to understand, but at the same time there are some nuances that you can exploit, right? So here's an example of a divergence. Price makes a higher high here, and your stochastic is making a lower trend down. It's a lot easier to see, of course, here on the slow stochastic. It's making an obvious lower high, but as you can see, as soon as you get that lower high, it doesn't go straight down. It goes down a bit. That's why it is definitely important to use confluence. I probably would have taken this divergence trade, and you may have gotten out here at a small profit, which is pretty good. And then, of course, you could have taken the second one as well when you triple top there. Anyway, so I think that is going to probably be about it for the stochastic. Like I said, it's a very easy indicator to understand, so it doesn't require much talking. And of course, it is very similar to the RSI, which we have already gone over if you'll go look through that video as well, you can use the stochastic a lot of the same ways you can use the RSI. So in order to keep this kind of short, I'm pretty well going to cut us off here so that we don't just drone on all day going through charts and stuff. I hope this has helped you guys out. So if you enjoyed yourself, please do remember to like, subscribe, and comment, and we will see you in the next video. Cheers.